But it's not just about AI. It's also deregulation. It's also dollar weakness for exporters, low cost of debt, tax cuts, and all that could have positive impact going forward.
Hello, everyone, and welcome to our Market Outlook podcast called What is Behind the FOMO Rally? Hi, I'm Rick, and thank you for joining.
Hi, Lorna. Hi, everyone. It's always a pleasure to join you.
So-called FOMO, this fear of missing out, has propelled a rally in markets ever since the adjustment to higher US trade tariffs in the spring. Let's look at what is behind this rally, apart, of course, from a good deal of momentum, Imric.
Yeah, sure. So since May, and we've seen, obviously in April, an extremely volatile episode for markets, for equity markets especially. And that was experienced after Trump's Liberation Day tariff announcement. So since May, equity and credit markets in general have benefited from a de-escalating trade war, but also from strong interest in AI, so artificial intelligence, and that was amid unprecedented investments that were announced by the like of NVIDIA, Microsoft, or Oracle, OpenAI, so the traditional names in this field. And in addition, we are in a very particular environment where not only earnings growth is positive and expectations is for those to trend higher, but we also in the midst of accommodative monetary and fiscal policies, and that remains supportive for equity markets. So investors have kept buying over the summer. Usually in the summer, we tend to pause in August, September, but that wasn't the case this year. And they kept buying probably because of this fear of missing out. And as a result, it pushed valuation multiples to elevated levels for some markets, such as NASDAQ, to AI related again. If we look at now year to date, the S&P is up 14%, the NASDAQ 20-ish, and even Chinese shares. So Hong Kong is up 30%, and Chinese shares, I think, even more. We also had credit spreads that are close to an all-time low. So people continue to buy pro-cyclical assets. Now, on the other side, we have also an asset that has done extremely well, and usually this asset doesn't tend to do that well when equity markets do or are super strong as they've been. It's gold, and gold has taken the role of the diversifying assets in this space compared to fixed income of the last few years. Now gold is up more than 50%, and investors are looking at it as a currency of last resort, again amid a weak dollar, and they see it as a safe haven amid elevated geopolitical risks. So in a sense, more recently, gold has also benefited from retail investors' flows, so it's not just something for institutional clients or a niche, and also probably because of fear of missing out.
Yes, indeed. And gold has been on an absolute streak this year, as you say. But if we take a step back then, economic data do appear resilient, and that not least in the US.
Yeah, so all that obviously has happened in the context of improving economic data. I was talking about the fiscal and monetary environment, but if we look at most company surveys, such as PMI, so the purchasing manager indices, so we survey purchasing managers at corporate level, those indicates an expanding global economy, both for services, but also more recently for the manufacturing sector. Manufacturing sector has been in contraction mode, or contracting, sorry, for some times now. and which also explains the poor performance of an economy like Germany. And investment, especially in AI-related industries, are, as I mentioned, unprecedented, and that has really helped the US economy stay afloat. The second quarter in the US surprised positively. The PIB, the real economic growth surprised positively. And it's expected to remain strong in the US also this quarter when we look at, for example, the Atlanta Fed GDP forecast that are around 3%. Now in Europe, European growth has also remained resilient, thanks to the ECB's rate cuts and Germany's budget plan. But to be honest, it's not really thanks to Germany or France. It's probably more to the positive momentum from countries such as Spain, Italy, or even Greece. AXA in general have increased their economic forecasts for both the US and for Europe, and have been a bit more cautious on the level of inflation, so around the 2% mark, 2.2% mark in Europe, but still 2.9 to 3% in the US being expected.
Yes, but that isn't quite what analysts were, or economists, sorry, were expecting to happen after this higher level of tariffs became established.
Yeah, you're absolutely right. So those forecasts from AXA, for example, on the growth side have substantially increased compared to where they stood in April or in May. Same inflation, the forecasts have come down compared to where they were in April or May. And today, consumers face a higher effective tariff rates in the US. It's a rate of 18%. Just as a reminder, at the start of the year, we were at 2 or 3%. So that's the highest since 1933. So the question is, how the 18% will be split between companies, between their suppliers, and between the consumers. And so JP Morgan Asset Management did an analysis on that. We continue to do research in this space, so it's early stage, of course. But what was interesting was 54% of the companies that were surveyed by the research had a strategy in place in August to face tariffs. That means 46% didn't have any strategy. And 17% of the companies are passing tariffs to their customers only. And then you had roughly 20% passing it on to more efficient methods to manage expenses or to manage stocks, and roughly 20 to 30% plus trying to manage it through their supply chain. Yeah. So it shows some absorption through the margins. It shows that the problem was also passed down the supply chain, so squeezing some smaller companies probably. But the impact on the end customer has been so far relatively benign. So we may see gradual but shared impact across the various stakeholders.
Yes, it will be interesting to see how that evolves. But if we look at the US data that are coming through, and obviously some of them aren't coming through at the moment, but we've seen a particular area of weakness in the labor market, and it was that seemed to have prompted the Fed to cut rates last month.
Yes, so obviously it was expected. There was a lot of pressure. We discussed it from the Trump administration to ensure the Fed cut. But it was the right time. It was probably the right amount of rate being cut as well. So just as a reminder, the Fed cut its rate by 25 pips to 4.25. They called this action a risk management action. So they are in a risk management mode in response to possible future weakness in job market. I think the fact that inflation remained below 3%, so the point we raised earlier, also helped them to help them take the decision. The weakness seems to come from on the job side, seems to come from a lack of job creation rather than the job cuts. However, as companies absorb some of the cost, they may also remain cautious on how they manage expenses and investment, as we just discussed earlier, regarding their strategy to handle tariffs. So therefore, it's likely that the amount of job creation remains, again, probably limited for the coming month. Now, we expect, I think, FOMC as well, and the market expect 2 additional rate cuts. Powell recently indicated that such cuts will take place, or are strongly likely to take place. So even this month, in October. And what was interesting is that a new voting member joined, Steve Mirren. He was appointed by Trump. And when we look at the various survey of the voting members at the FOMC, we saw that there was one strong outlier who was voting for 150 basis point rate cut by year end. So,
and this we can see in the dot plots, can't we? It's very visible in the dot plots. There's an outlier there.
Absolutely. And I mean, Steve Mirren didn't hide himself. He did say it was his views, which was consistent with Besant's preference as well. So, but it seems that he's being isolated for now, and although the Fed, on average, the median view is for 2 rate cuts this year. It's only for 1 rate cut next year. And if we look at the difference for next year in particular between what the FOMC median target is and the market view, the market expects 3 rate cuts. So there's quite a gap. We're talking about 50 bips gap. So labor and inflation data will drive this gap going forward. For now, official data are not being released. We have the federal government and agency being shut down in Washington may also let some of the federal jobs go, which will make more likely the Fed to cut rates as expected.
Well, yes, and that's in response to a sort of underlying economic weakness. Now, that might not be good for corporate profits. So how will equity markets maintain this rally?
So the job front, again, it's more lack of job creation rather than job cuts. And the fact that the Fed are cutting rates is a positive and may offset that. However, although earnings this year have not been very strong, if you just look at the S&P 500 and you extract the Max 7 in the second quarter, those companies have only grown earnings roughly 2 to 4% per annum. So it's quite low. But what is striking is what is expected going forward on 2 fronts. First of all, we looked at profit margins, and margins this year have surprised analysts on the upside. So companies have scaled hiring down, probably passed on previous input price and wage increases to their customers. So the tariff is another story. But as a result, they managed to maintain and even slightly increase their margin. And the margin trajectory for the S&P 500 for the next 2 years is at roughly 1% per annum. So we're around the 14-15%, going up to 16-17%. It's huge. Those are very, very high profit margins. So part of those expectations could be linked to AI. Indeed, the hyperscalers, the Amazon, Meta, Microsoft, etc., are spending $300 billion in capex, which is almost 50% of their operating cash flow. But the adoption trend is growing, and the adoption growth rate varies across sector. So we'll have to see how effective those productivity gains will be. So it's still unknown, but it's not just about AI. It's also deregulation. It's also dollar weakness for exporters, low cost of debt, tax cuts, and all that could have positive impact going forward.
Yes, there is a lot for markets to be pricing in at the moment. So how are we reflecting all this in our asset allocation?
Yes, so this environment, this monetary, fiscal, and economic environment, and expected earnings growth, all that is still supportive for global equities. Now, we do know that valuation multiples are elevated, and that may mean some volatility going forward, a bit more volatility than what we have experienced recently, simply because the market is pricing in optimistic forecast. But the trend may continue as long as we see positive earnings growth momentum, and as long as we see a translation of the investment in AI, a translation into productivity gains. So for this reason, we're still patient and maintain a preference for global equities. We don't really express a regional equity preference. We just favor regional diversification. We also keep some position in credit, so we don't really expect spread to contract, but it's more in terms of total returns. We still expect, especially in Europe, credit to deliver higher total return than cash and potentially than government bonds. So that's why we prefer high yield and a bit of IG in Europe compared to government bonds. Why? Because they still face yield may still face upward pressure amid pickup in inflation, or simply because of the issuance of bonds in order to finance budget deficits going forward, especially in Europe.
Well, thank you, Aymeric, and until next month's Outlook podcast.
Thank you, Lorna. Thank you, everyone.